Hey everyone, it's Neo, your gold trader. As you know, I've been aiming to turn a $100,000 account into $1 million in just 1 week. Unfortunately, as you can see from the final results, I fell a bit short, ending up with $926,845.10. I'll be breaking down exactly what went wrong in this video, so stick around to the end. For those of you who want to follow along, I recommend opening up TradingView and comparing your charts to mine. To save time, I've sped up the video to 1.6x speed, but feel free to pause or rewind whenever you need to. Please note that this video is intended for advanced traders who already have a solid understanding of technical analysis. I'll be focusing on the mindset and money management aspects of this trade, rather than getting bogged down in the specifics of my entries and exits. Let's dive in. Alright, let's pick up where we left off yesterday and dive deeper into the topic of optimizing your trading environment. We discussed the importance of distancing yourself from negative influences or dream killers as you work towards your trading goals. Remember, to achieve a specific target within a set time frame, you need to think in reverse. We established that your goal is to develop the skill of consistently turning $100,000 into $1 million in a week, year after year, eliminating luck as a factor. To achieve this, 6 months from now, you should be able to consistently turn $10,000 into $100,000. It could be $20,000 into $200,000. The key is to be able to multiply your capital by 10. Now, let's break down how to allocate your trading days within a week. Assuming you trade 5 days a week, you need to understand the unique characteristics of each day, from Monday to Friday. I've covered this in detail in my Intense Focus video series and the complete manual video, so feel free to check out my YouTube channel's playlist for more information. I particularly emphasize 2 key aspects: Monday's Monday Dash and economic indicator trading. The Monday Dash refers to the common practice of traders worldwide analyzing and evaluating the previous week's market movements over the weekend. This shared analysis creates a consensus among traders, leading to similar strategies and outlooks. In other words, it's a time when everyone tends to agree on the market direction. This consensus creates a prime opportunity for traders, making it a lucrative time for many and a nightmare for brokers. In my December 2nd live trading video, I started with $100,000 on a Tokyo trading day and turned it into $2 million within a day. This wasn't luck. It was a direct result of capitalizing on the widespread consensus among traders. The deeper your understanding of market conditions, the better equipped you'll be to take advantage of the Monday Dash. You can see for yourself by watching my past Monday trading videos. The days are labeled in the thumbnails, so you can easily find them. Next up, let's talk about economic indicator trading, another significant opportunity for substantial profits. It's important to understand that economic indicators aren't just tools for predicting whether a number will go up or down. They're triggers that signal a shift in market sentiment. Essentially, they condense the usual day-long market movement into an hour or 4 hours. If you're an advanced trader, you likely already understand this concept. Renowned traders like Aki-chan Junkyo and Mashiro have also discussed this in their videos. I've also shared my approach to economic indicator trading in previous videos, breaking it down into 4 distinct patterns. So, let's build our weekly trading plan around these 2 major opportunities: the Monday Dash and economic indicator trading. Surprisingly, the next component is a day off from trading, or you could call it a risk-off day or a brain rest day. After a significant win, our brains are flooded with dopamine and adrenaline, which can lead to overconfidence and emotional trading decisions rather than logical ones. Many experienced and professional traders know this from personal experience. They've often experienced a cycle of big wins followed by significant losses, sometimes even wiping out their entire account. It's through these repeated failures that they've learned to avoid such pitfalls and become the skilled traders they are today. You've probably heard countless times that the key to success lies in minimizing losses, or in the adage, know when to fold them. Personally, I like to say that overconfidence can ruin everything, But let's get back to the main point. To summarize, our weekly strategy will revolve around these three pillars: the Monday dash, economic indicator trading, and a rest day. This is what we call a trading strategy. If you're already a seasoned trader with a proven strategy, incorporating these elements into your routine should make achieving a tenfold return within a week quite achievable. Of course, some of you might wonder why you'd need to go to such lengths if you're already profitable. Many full-time traders find themselves bored after a while, even after satisfying their material desires. They end up returning to part-time work. Personally, I've found myself getting into video production and even considering hosting study groups to connect with fellow traders who share the same approach. And why not aim for a 100-fold return in a week? Even if I fail, the potential loss is limited to a single attempt, and any profits would be significantly reduced by taxes. Some might call it entertainment, and I agree. For me, trading has become like an online game. I've been going down a rabbit hole about ADHD lately, and it's got me thinking about something else: how money can change a person. It's fascinating to watch. I've noticed that people who suddenly become wealthy often undergo a transformation. They start to become the kind of people they used to despise. It seems like many of these success stories are actually cautionary tales. Before they struck it rich, these individuals were often surrounded by people in similar financial situations. But once they started making serious money, they attracted a whole new crowd. People who were envious, jealous, or simply looking for a handout. It's almost like they got a first-hand look at human nature, realizing that their former friends were only interested in them for their money. Sooner or later, these newly wealthy individuals realize that they've been judging others in the same way. At first, they feel on top of the world, believing they've earned their success through hard work. Driving luxury cars and spending lavishly on dinners becomes the norm. But from an outsider's perspective, they often come across as arrogant and condescending. However, traders who've managed to stay in the game for the long haul tend to be much more humble. They've experienced significant losses and understand that FX is ultimately a gamble. Even legendary traders like BNF, with a net worth of over $10 billion, acknowledge the unpredictability of the markets. In fact, he's often expressed concerns about his market insights becoming outdated. When SoftBank's Masayoshi Son offered him funds to manage, BNF declined, stating that he didn't want to risk other people's money. BNF's pseudonym is a reference to Victor Niederhofer, a brilliant trader who achieved great success until the 1997 Asian financial crisis. Niederhofer's fund collapsed, and he suffered another major setback during the 2007 subprime crisis. These stories highlight the importance of humility in trading. It's ironic to see people on platforms like X promoting get-rich-quick schemes and free EAs, preying on the gullible. I often find myself thinking, here we go again, someone trying to scam the less informed. Okay, let's get back on track. Even with my ADHD-fueled tangents, I want to refocus on our main topic. Successful traders often have a select few strategies that align perfectly with their trading style and strengths. They stick to these strategies religiously and avoid experimenting with others. We all know that there's no foolproof strategy and that the effectiveness of a strategy can fluctuate based on market conditions. It's also common knowledge that trading ranges and trends require completely different mindsets, which can be mentally taxing. That's why many successful traders avoid complex or risky strategies. They prefer to stick to what they know and avoid making decisions based on theory alone. They leave that to the beginners. Let's say you've mastered 2 or 3 strategies, such as trend reversal trading and breakout trading from consolidation patterns. By consistently refining these strategies and applying them across different time frames, you can easily grow an account from $100,000 to $1 million. There's no need to complicate things by trading multiple currency pairs. Just focus on a few that you're comfortable with. Many successful traders like Lion Chan, who focuses on pound sterling to Australian dollar, Mashiro, who specializes in gold, and Aki-chan, who focuses on US dollar to Japanese yen, have proven that this approach works. It's like seeing celebrities who've made it big in the entertainment industry get lured into bad investments by their managers. They trust their managers and blindly invest in ventures they don't fully understand. It's a common pitfall for the newly wealthy. When it comes to choosing strategies, 2 or 3 well-mastered techniques are sufficient. By focusing on refining these strategies, especially when applied to a specific asset like gold, you'll be well on your way to success. So, we've now covered half of our weekly trading strategy. Now, let's talk about incorporating financial management into our strategy. We're going to dive into compound interest, a concept that Einstein called the greatest invention of mankind. Put simply, compound interest can be a powerful tool, but it can also be misused to exploit those who are less financially savvy. It's the foundation of debt traps and predatory lending practices. While regulations have made such extreme practices less common in developed countries, they still exist on the fringes of society. When used incorrectly, compound interest can be a dangerous weapon. It's like handling a toxic substance without proper training. Yet many inexperienced traders use it without fully understanding the risks. This is evident in the market's volatility, which often coincides with unusual events like widespread transportation disruptions. In addition to compound interest, there are 2 other dangerous financial tools: martingale and parley. These are like using chemical weapons like sarin or mustard gas. It's a thrilling concept, but it's important to approach it with caution. To mitigate these risks, I propose a simple solution: a zero-cut system. Essentially, you start with a fixed initial investment, say $100,000. That's your maximum potential loss for each trading attempt. I've personally used this approach for my $100,000 to $1 million challenge. So far, I've had 8 unsuccessful attempts, resulting in a total loss of $800,000. But since I've been transferring my profits to a separate account, I've managed to recover most of that loss. In conclusion, whether you're using compound interest, martingale, or parley, the maximum potential loss should be predetermined. This prevents you from making impulsive decisions and risking more than you can afford to lose. By following this approach, you can enjoy the thrill of trading without putting your entire financial future at risk. Asterisk, let's dive into compound interest, a concept so powerful that Einstein himself called it one of humanity's greatest inventions. Simply put, compound interest is the interest on an initial deposit or loan, and then the interest on the growing total, including previous interest. While it can be a powerful tool for building wealth, compound interest can also be exploited. In the past, it was common for unscrupulous lenders to exploit vulnerable individuals by trapping them in a cycle of debt. They would lend excessive amounts of money with high interest rates, making it nearly impossible for borrowers to repay. This would lead to a cycle of debt, often resulting in bankruptcy. While laws and regulations have been put in place to protect consumers, we still see similar behaviors today. For instance, individuals who become deeply indebted to high-interest credit cards or those who fall victim to predatory lending practices often find themselves in difficult financial situations. It's crucial to understand how compound interest works to avoid becoming a victim of financial exploitation. By understanding the mechanics of compound interest, you can make informed decisions about your finances and protect yourself from unnecessary debt. Asterisk, compound interest is a double-edged sword. While it can significantly grow your wealth, it can also lead to devastating losses if not managed correctly. It's like handling a dangerous chemical. Without proper precautions, it can cause severe damage. Beyond compound interest, strategies like martingale and parley are equally risky. These aggressive strategies, often compared to gambling with financial instruments, can quickly wipe out your trading account. Imagine these strategies as weapons of mass financial destruction, similar to chemical weapons. Many experienced traders warn against these high-risk strategies. However, few truly understand the underlying mechanics and the potential consequences. Let's visualize this using a mathematical concept: exponential growth. When profits compound, they grow exponentially. But conversely, losses also compound exponentially. This means that during a market crash, when everyone is selling and there are no buyers, your losses can quickly spiral out of control. To mitigate these risks, many brokers offer a zero-cut system. This means that your losses are limited to your initial investment. If you start with $100,000, the most you can lose on any given trade is $100,000. By understanding the risks and implementing risk management strategies like a zero-cut system, you can protect your capital and increase your chances of long-term success. Remember, while high-risk strategies can lead to significant gains, they can also lead to equally significant losses. It's essential to approach trading with discipline and a clear understanding of the potential outcomes. Asterisk now. Let's dive into how to maximize these three strategies with a $100,000 account. For your first trade, wait for a setup where you're absolutely confident of success. I usually find at least 3 to 4 such opportunities per day across different time zones like Tokyo, London, and New York. Even with my impatient nature, I can wait that long. After all, waiting for a larger price movement can lead to significantly higher profits. When that perfect opportunity arises, it's time to employ what I call the gambling theory. Bet big. Small positions will eventually lead to losses. I've explained this strategy in detail in my previous videos, especially in the Essence Concentration Course playlist. I also recommend watching videos on Sun Tzu's Art of War for a deeper understanding of the strategic approach. I assume that you already have a solid grasp of fundamental concepts like risk-reward ratio, return on investment, and expected value. If you're a consistently profitable trader, then this is old news. I'll also assume that you understand the mechanics of martingale and parley. In essence, with a zero-cut system and a focused approach, you can leverage these strategies to maximize your profits. Remember, patience and confidence are key. Bet big when you're sure and let your profits compound. Let's delve into the fascinating interplay between financial management and brain function. I'm going to use my current trade on the New York session as a real-time example. Even though it's a trade I'd rather avoid, I'm just $160,000 away from my $1 million goal, and I'm currently holding a position size of 20 lots. When I started with $100,000, I was comfortably taking positions of 2.0 lots for each trade. The thinking was, if it goes wrong, I lose $100,000 at worst, but if it goes right, I can make $300,000 for $100,000 or even $500,000. Reducing my position size to 0.02 lots at this point would be foolish. However, I've noticed something peculiar. I've been struggling to read the charts effectively. As I discussed in a previous video, this is likely due to my position size expanding beyond my psychological comfort zone, triggering a homeostatic response. Since my account surpassed $780,000, my rate of return has significantly decreased. My trading strategies are no longer aligning with the actual market. Moreover, I'm finding it increasingly difficult to maintain composure when faced with even a $200,000 drawdown. Fear and attachment are starting to creep in. This is a crucial moment. How should we interpret these feelings? This is a classic example of a learning plateau. Our brains are still processing the information, and the discrepancy between our understanding and our actions is causing our subconscious mind to resist further change. Given that I've only achieved a $1 million account twice in my life, it's no surprise that my experience is limited. My conscious mind might understand the concepts, but my subconscious, which controls habits and emotions, is struggling to adapt. Think of a chart as a range. When we're in a losing streak, it's like building up to a cluster. The longer we stay in this learning plateau, the more powerful the breakout will be. This is like a singularity, where a small change can lead to a massive explosion. The brain strain is real. I've learned firsthand that handling a $200,000 drawdown on an $800,000 account is no easy feat. Let's break down the request and provide a tailored response. Prompt analysis, target audience, American FX traders, content, a personal reflection on a near-miss trade, discussing the psychological challenges and the motivation behind pushing for extreme profit targets. Tone, reflective and philosophical, with a touch of self-deprecation. Key points: the pursuit of challenges, the limitations of the human brain under extreme conditions, and the importance of risk management. English translation: I know what you're thinking. Why would anyone take such a risk when they're already making a decent profit? Well, it's like asking why climbers climb mountains or why athletes strive for world records. There's an innate human desire to push boundaries and explore the unknown. It's similar to asking why a sprinter will want to run the 100 meters in under 9 seconds, or why a Formula One driver would risk their life at high speeds. It's about pushing human limits, not just about the practical outcome. In my case, I'm using this as an experiment to understand the limitations of the human brain under extreme pressure. I was so close to my $1 million goal, but ultimately, my brain's capacity for rational thought started to decline. The late-night trading sessions took their toll, and I made a suboptimal decision. I set a take-profit order, thinking I could secure my profits for the weekend. Unfortunately, I was just $80,000 short of my goal. Looking back, I realized I should have increased my position size to the maximum allowed by my broker. So, starting next week, I'll be back at it with a fresh $100,000 account. This is just one step closer to my ultimate goal. Until then, farewell.
Thank you for watching until the end. If you found this video helpful, please like and subscribe. Also, I'm available to answer any questions you may have about gold trading on Discord. Additionally, I offer free Google Meet consultations every Sunday from 6 p.m. to 8 p.m. where you can ask questions about trading or discuss your concerns. Feel free to utilize this opportunity to improve your gold trading, not only in terms of technical analysis, but also brain and finance management. You can find the link to the Discord in the description. I look forward to seeing you all again in the next video. Please don't hesitate to join us.